Hey there, I'm Jeff with The Simple Dollar. Today we're talking about secured versus unsecured personal loans. So we'll cover what's the difference, what are some of the main pros and cons, what are some of the common types, which is better, and do you need a cosigner? So hopefully you find the video helpful. I'll put a lot more information for you down below in the description. We did a full roundup list of the best personal loan companies and the rates, and so there'll be a lot of stuff for you to check out down below in the description. Hopefully I earn your thumbs up. All right, so back to personal loans, secured versus unsecured. What's the difference? Well, a secured personal loan is one where a borrower puts up some form of collateral as a guarantee in the case that they default on a loan. So essentially you get money, but that money is backed by a valuable asset. The most common types of secured personal loans are mortgages, because it's backed by your house, auto loans that are backed by your car. You can also see home equity lines of credit, home equity loans, those sorts of things. Sometimes companies will even allow you to use your savings account or a CD account, sometimes even brokerage accounts for collateral for a loan. I know sometimes Wells Fargo does it, Navy Federal Credit Union does it, but in large part, a secured personal loan, the best examples are auto loans and mortgages. Now, an unsecured loan is just a loan where you promise to pay back the money. You're not putting up any sort of collateral. You're just saying, I get this money, I will pay you regular payments, and by the end of it, you will have all your money back. You have no asset that's placed as collateral. Now, the most common types of unsecured loans are debt consolidation loans, where you have all this debt, maybe credit card debt, maybe medical bill debt, maybe student loans, and you kind of package it all into one source, and you pay one company, you pay one payment, so you're consolidating all of your debt. You'll also see home improvement loans that are different than like a home equity line of credit or home equity loan or a second mortgage. You'll also see medical bill loans. So there are specific unsecured loans out there. Interestingly enough, there's been this giant wave of online lenders, reputable online lenders like SoFi and Payoff and Lending Club. And they offer a lot of unsecured loans where you're just promising to pay back the money and they have favorable rates. And we did a roundup list of some of the best online lenders, best personal loan lenders, and I'll try to link that for you down below in the description. So let's cover some of the pros and the cons of secured and unsecured loans. So for secured loans, one of the biggest pros is that you can oftentimes get more money. So think of a mortgage, right? Nobody is gonna lend you $400,000 without some sort of collateral, which is why mortgages are backed by the house. Also, usually because you're putting up collateral and you're becoming thereby less risky, you're getting a better interest rate. Again, because the bank is a little bit more protected in that case. And with all of that, a secured personal loan usually has a higher rate of approval because you are becoming less risky to the lender. Now, a lot of the advantages for a secured loan are the disadvantages for an unsecured loan. So an unsecured loan has a lower approval rate. Usually you're getting a smaller cash amount, somewhere between $5,000 and maybe $50,000. Typically because it's more risky, you're paying a higher interest rate. Like as an example, when I'm filming these videos, interest rates are like 3% for a mortgage. Somewhere right around there, really, really affordable. But a personal loan that's unsecured may be somewhere north of 10%, maybe 6, 8, 9, 10, 12%. So typically you pay a higher interest rate for an unsecured personal loan. And with those unsecured amounts, you're less likely to be approved because typically they go with the most credit-worthy borrowers. Now I'm painting sort of a doom and gloom picture for unsecured personal loans, but they do have major advantages, namely, you're not putting up any collateral. Also, they typically have fewer restrictions on how you can use the money. So if you go to some of these online lenders, I just was at SoFi's website, and you can actually use that money for a lot of different things, not just say to buy a house or hey, buy a car. You can use that unsecured personal loan for more things. And typically the approval and denial process is actually faster with an unsecured personal loan because they're heavily weighting your job, your credit history, your credit score, your debt to income ratio, so they can more quickly make a decision. So those are the main advantages for an unsecured personal loan. Like you guessed, a lot of the advantages for an unsecured personal loan are the disadvantages for a secured personal loan. For example, you're risking collateral in the event of a default. It's still risking your credit score, even though you're not putting up any collateral, and there's stricter limitations on how and where you can spend the money. As for the question of whether or not you need a cosigner, oftentimes it comes down to just if you want to get a better rate. So if you don't have a really long history of credit or a great credit score, by adding someone else that does have those, you can typically get a lower interest rate. So most of the time, a cosigner is not necessary. I got a mortgage. I do not have a cosigner on the mortgage. I got the rate that I wanted without having someone else on it. But if you feel like you're not gonna get the rate that you want, you can have somebody that has better credit, longer credit history on both unsecured and secured loans to drive down your rate. But it's oftentimes not necessary. In terms of which one is better for you, it just comes down to your particular situation. If you're trying to buy a house, get a mortgage. If you want a car, get an auto loan. If you want to pay down a bunch of debt and consolidate your debt, get a debt consolidation loan. If you want to make a larger improvement or repair to your home, but you don't want a second mortgage, then do a home improvement loan. So there are definitely advantages and disadvantages to both of them. You have to know what you're getting yourself into. We are in no way telling you to get a loan. You have to really consider what is best for you. But hopefully this video was helpful. And like I said, there's a lot of resources for you down below in the description. I'll see you next time. Have a great day.